Imagine waking up one day and realizing that everything around you has become more expensive. Your food costs more, your rent increases, even basic necessities feel heavier on your wallet. But inflation does something even deeper. It changes how people invest their money. When inflation rises, investors start thinking very differently about risk, safety, and growth. Inflation simply means the gradual increase in prices over time. As prices rise, the purchasing power of money slowly decreases. In other words, the same amount of money buys less in the future. When inflation rises, investors become more cautious about where they put their money. Cash sitting in the bank starts losing value. So investors begin searching for assets that can beat inflation. During inflationary periods, investors often move toward real assets. Assets like gold, commodities, and real estate tend to protect value because, unlike paper money, real assets have intrinsic value. Inflation does not affect every investment in the same way. For stocks, the impact can be complicated. Some companies actually perform well during inflation because they can increase the prices of their products. Businesses in sectors like energy, commodities, and consumer goods often pass rising costs to customers. But not all companies have that power. Companies with weak pricing ability may struggle as their costs rise faster than their profits. As a result, investors begin analyzing companies more carefully during inflationary periods. They start favoring businesses with strong pricing power and stable demand. Inflation has a strong impact on bonds. When inflation rises, central banks often increase interest rates to control it. Higher interest rates usually reduce the value of existing bonds. This happens because newer bonds start offering higher yields than older ones. As a result, investors holding long term bonds may see their bond prices fall. Because of this risk, investors often become cautious with fixed income investments during high inflation. Inflation also creates psychological pressure on investors. When people see prices rising everywhere, they begin to worry about the future. This fear can influence financial decisions. Some investors rush into markets hoping to grow their money faster. Others become extremely conservative and move their money into safer assets. This emotional reaction often increases volatility in financial markets. Understanding this psychological behavior is crucial for long term investing. When inflation rises, investors often rebalance their portfolios. They reduce exposure to assets that struggle during inflation. At the same time, they increase investments in assets that historically perform better. This may include equities, commodities, real estate, or inflation protected securities. Diversification becomes even more important during uncertain economic conditions. A balanced portfolio helps reduce the risk created by rising prices. History provides many examples of how inflation changes investment behavior. During the 1970s, many economies experienced high inflation. Traditional savings lost value rapidly. As a result, investors shifted toward assets like gold, commodities, and real estate. These assets performed much better compared to cash savings. Such historical periods remind investors why inflation protection matters. To protect themselves from inflation, investors often adopt specific strategies. One strategy is investing in companies with strong pricing power. Another strategy is allocating a portion of the portfolio to commodities or precious metals. Real estate is also considered an effective hedge against inflation. Some investors use inflation protected bonds designed to adjust with rising prices. The goal is to maintain purchasing power over time. Inflation is a natural part of every economy. It cannot be completely avoided. But investors who understand its effects can adapt their strategies. Instead of reacting emotionally, they focus on long term growth. A disciplined approach helps investors navigate periods of rising prices. Ultimately, successful investing is about protecting and growing purchasing power over time.